What's going on, guys? Bexio back, and today we've got a brand new video on the stock market and should you be investing during these crazy times of volatility where the market seems to be back in free fall. And we have a chart right here that I'm going to go over, and we're going to see why the difference between putting money in and not investing the right way, basically like just putting money in a lump sum instead of being consistent and stuff like that, the way a lot of long-term people preach. But we can look at this chart right here, and it is obviously, if you have $10,000 and you lose a percent of it, then how much does you have to go back to break even? So this first line you can see is it's $10,000 and then you lost 10%, which would be a $1,000 loss, meaning you have $9,000 left. And to get back to 10,000, you need that 1,000 you lost, which would be an 11% gain. So it's not, if you lose 10%, you don't need to make 10% to break even. You need to make 11% because you no longer have the 10,000. And 10% of 9,000 is 900, and it's not going to bring you to 10,000. You need 11% to get back to 10,000. So when you look more extremes, like the 50% one, if you had 10,000 and you lost 50%, you would have 5,000 remaining. And then instead of needing that 50%, you need 100% of your money, of the gains, just to get back to break even. So why am I bringing up this chart? And in these weird volatile times in the stock market where you might not want to put money in, but being consistent and having an amount that you're comfortable with putting in every month is important, because if we can just take this $10,000 and 50% loss one, when you're down to $5,000, you need $5,000 to get back to $10,000. But if you put in $3,000, now you have $8,000 and you have $13,000 your break even. And by doing that, you will have that $5,000, but it'll be $8,000 that'll be working. So instead of needing 100% to break even, now you only need 62.5% to break even. So that $8,000, 62.5% is $5,000, and that'll bring you up to $13,000, which is your new break even because you put money in. But by putting money in, you're making it easier for your money that's left to work. It doesn't have to work as hard just to get back to break even. So if you got that 100%, that would be almost a 40% gain of just profit, because it's no longer needing to break even at 100, it's breaking even at 62.5%. So this is the correct way that I see investing as, especially if you're doing long-term investing, is pick an amount every month that you're comfortable putting in, so that when there's this time like right now where the stock market's down, but if you've been involved since, even if you bought it at the peak and started buying before the pandemic dropped and continued buying on the way down and continued buying on the way up, you would still be up money, even though this is a big correction of like 10% right now that we're in. So it's not like it would destroy your profits. You would still have profit, and you would be able to be putting money in, so that small amount, the 10% of, I think the market recovered like 40 or 50% in that time. So that 10% you lost, you don't need to work at 11% to get it back. If the market goes up 3%, 5%, you could get your money back to break even and start making money once it starts going up again. So basically there's 3 examples that I'm going to break down here too, of like a fictional 3 different types of people where we've had, I think it's 5 crashes of the stock market. So the 5 different types of crashes that have occurred are right here we can see, we're assuming a date of 87 to 2020. Those would be the dates of investing. And so we had obviously the crash in 87. I wasn't even alive, so don't know about that. But it was a 33.4% drop. The next crash was in 1990, which was a 19.7% drop. Then we had the 2000 to 2002 crash, which was a 49% drop. And now the first crash that I actually know a little bit about is the 2008 financial crisis that happened, which was a 2007 to 2009 was the range of that, I guess bear market you could call it, but it was a 56.5% drop. And then we had the 2020 crash of 34.1%. So we're going to have 3 different investing strategies from 3 different people, and let's just give them these random names. We can do Brad, Timmy, and Jimmy. We'll just do those 3, Brad, Timmy, and Jimmy, and they all 3 had different investing strategies, and they all figured out that long-term investing, long-term holding of stocks is the way to go and the way they want to invest. And they all are, we're going to assume they have $99,000 they're investing, and that they never sell their stocks, and that if they don't have their money in the market, they're holding it at a 3% annual yield high interest savings account. So of these 3 different people, Brad, Timmy, and Jimmy, they all have their different characteristics. And starting off with Brad, he decided that he's going to time the market, and he has the worst timing known to man, and he buys at the top and peak right before every single crash that has happened since 1990. So the first one, he loses 19.7%, 2002 loses 49%, 2009 loses 56.5%, and 2020 loses 34.1% at the time that he invested. But he never sells his stocks. He holds on to them throughout the whole time. And at the end of all of this, he ends up with $773,358 from buying at the worst possible times that you could, at the peak of every market bubble. And now Timmy, on the other hand, is a god, and he times the market perfectly, buying at the bottom of every single stock crash that has happened since 1990. And he manages to make, over 40 years, he makes $1,123,573 from timing the exact bottom of the market 5 out of 5 times, which is basically impossible. And when you look at these numbers between these 2 extremes, buying at the top of the bubbles and buying at market bottom every single time, it's kind of surprising that when you compare Timmy to Brad, that Timmy only made like 400,000 more dollars, which is like 45% of being the best timer in the world, which is just not expectable. You cannot do that. Nobody can do that. So, but it's not that much bigger of a gain when you consider buying at the worst time and the best time every time. So the last person we have is Jimmy, and he decides to invest consistently from the start. He's not going to time the market or do anything. He's just going to put in $200 a month for 40 years and just not even think about it. And he's not even going to pick any stocks. He's going to buy index funds of VTI or VOO, which are broad market index funds that you can invest in. And after 40 years of doing this, of just consistently, regardless of what happens in the markets, just putting in $200 a month, ends up with $1,620,708, which is ridiculously more than the best timer in the market ever, Timmy, comparing that he's made almost $500,000 more by just being consistent. So when you look at this, timing the market is not something that people can do. I mean, you might get lucky in time near the bottom and then try and gloat and say that you got the bottom and you're so smart, and then the market will humble you after you decide that you think you're smarter than it. But the way this ties back to that chart we looked at of putting in money in lump sums and how much money you need to get back to break even, how much you need your money to work at, being consistent and investing the $200 a month lowers the amount that your money needs to work to get break even if it ends up going down a little bit, and boosts your profits that you can have by the end of it. So that's why investing consistently and picking an amount that you can do and be comfortable with is super important. And these are the 3 completely different types of strategies that people might get sucked into, of timing the market or being consistent. So when you look at these types of strategies, you really want to think that obviously we all want the best returns, and the hardest methods would be to time the market at the bottoms. And even if you do that, you can't make the money that someone would have made by being consistent. It's crazy to think about, but that's the reality that we live in. So, and I'm going to end this video off by saying one thing, and that is, in this time, this stock market, that it fell 10%, if you got uneasy and worried and nervous and might have even pulled the panic sell on some of your stocks, then you might have too much money invested. And that is not good for anybody. So obviously, when you're investing, make sure the first thing you build before you put money into the stock market is an emergency fund, so that you can have that cash of like 6 months of expenses at least, and you can have that in cash and not have to be so worried if the market has a correction or even a crash, so that you don't have to sell at losses or find, ways to make money or pay things and having to dig into losses in the stock market. That's not what anybody wants to do. So let me know what you guys thought of this video. Obviously, these 3 different people, fictional people, of investing and the different ways they go about it really shines light on why consistency can be key, and is something that I think everybody should be trying to do. And let me know what you guys are doing. Do you pick a solid amount every month you're comfortable with investing? Do you have stocks, or are you looking to get into stocks? And if so, you can click that link in the description to Robinhood and get your free 2 stocks that could be valued up to $1,400. So, guys, don't forget to comment, rate, subscribe. All that's all support. Real. I'll see you guys in my next video.